imagine buying a highly sophisticated, multi-million-dollar insurance policy designed specifically to protect your business from an absolute disaster.
Right, like a safety net.
Exactly. But instead of making your company look safer,
Yeah.
just holding that policy forces you to report these wild, unpredictable financial swings every single quarter.
Making you look completely unstable to the outside world, ironically.
Yeah, it's wild. And welcome to the deep dive. Before we begin, I want to give a very warm, cordial greeting to you tuning in.
Thanks for being here with us.
We want to explicitly mention that this deep dive is an activity of the graduate program in accounting at the Federal University of Pernambuco, which is widely known as UFPE.
It's an excellent program, honestly, and we're digging into some seriously rigorous academic work they've produced today.
We really are. We're looking at a comprehensive 2024 doctoral thesis authored by Elenildo Santos Bezerra, and this was developed under the guidance of advisor Prosaf Dra, Umbelina Cravade Teixeira Lagioia.
And it's just the two of them, right? No co-advisor on this one.
Right, exactly. Just the author and the advisor. And the depth of the data they compiled here is really substantial. Our mission today is to explore the intersection of corporate risk management, specifically hedging, and these super complex international accounting rules.
And then the thesis introduces the ultimate stress test to this whole system, which is the macroeconomic shock of the COVID-19 pandemic.
Yeah, the ultimate wrecking ball. We are focusing on how non-financial companies listed on Brazil's B3 stock exchange navigated all these waters.
Okay, let's unpack this because there is this fundamental tension between the real-world actions a company takes to protect its cash flows and how regulatory standards force them to, translate those actions onto paper.
Yeah, and the foundation of that tension lies in how modern accounting standards handle derivatives, specifically IFRS 9.
Right.
For anyone following corporate finance, the operational use of a swap or a futures contract is pretty straightforward. You have exposure to a fluctuating variable, maybe a foreign currency or an interest rate, so you buy a derivative to lock in your costs. So operationally, you've totally neutralized your risk.
Exactly. You're safe. But the problem arises when you actually have to document that derivative on your balance sheet.
Because under the standard IFRS 9 rules, those derivatives must be measured at their fair value. You are literally forced to mark them to market.
Which means looking at what that contract is worth right this very second. The compliance requirement dictates that any fluctuation in that fair value has to be pushed directly through the current period's income statement.
Oh, wow. So if you hold, like, a currency swap to protect a shipment of goods arriving next year, the value of that swap is oscillating daily based on the global Forex markets.
Yeah. Even though the actual business transaction, the shipment and the payment hasn't even happened yet.
Right. The company hasn't realized any actual gain or loss. They're just holding a defensive contract.
But standard accounting forces them to take those daily paper fluctuations and report them as actual hits to their quarterly profit and loss.
The thesis calls this the economically unjustified volatility problem, and it makes total sense why. It does, because the standard accounting treatment actively distorts the economic reality. I mean, it creates a scenario where a manager's perfectly prudent decision to eliminate risk results in an income statement that looks like an electrocardiogram.
Right, just massive spikes and drops.
Exactly. You show a massive paper gain one quarter, followed by a severe paper loss the next. Investors looking purely at the bottom line might conclude the company is engaged in wild speculation.
When in reality, they're completely hedged. They're just playing it safe.
Exactly.
It reminds me of how confusing personal finance would be if we applied these same rules to, like, everyday protection.
Oh, yeah. Like what?
Think about having an auto insurance policy. Imagine instead of just logging the steady monthly premium you pay, you had to report the daily, fluctuating theoretical value of that policy as your personal income.
Oh, that would be a nightmare.
Right. Like, if local accident rates spike one week, the intrinsic value of your policy changes, and suddenly your reported income plummets on paper. Anyone looking at your tax returns would think your core earning power was wildly unstable, completely missing the fact that you just have a static match protection for your car. That is a great analogy. It prevents stakeholders from evaluating the core operational engine of the business.
The noise of the insurance policy drowns out the actual performance of the car?
Exactly. But there is a mechanism designed to solve this within the IFRS framework, and it's called hedge accounting.
Which is an elective accounting choice, right? Like, a company has to actively choose to use it.
Yeah, it's totally optional. But when they do use it, the rules allow them to synchronize the timing. They match the recognition of the derivative's gains or losses with the actual income effects of the underlying item they're protecting.
So it smooths out the income statement, basically neutralizing that unjustified volatility.
The matching principle is the key there. If the operational loss won't hit the books until Q3, hedge accounting lets you park the derivative's offsetting gain in a separate equity account until Q3.
Oh, so you release them both into the income statement simultaneously.
Exactly. The net effect is zero, which perfectly reflects the economic reality of being fully hedged.
Okay, so my immediate pushback when I was reading this was simple. If hedge accounting fixes a blatant reporting distortion, why doesn't every single manager use it?
Well, you'd think they would, right?
Yeah, but the thesis makes it clear that many managers simply opt out and just take the hit on the volatility. There must be a massive administrative barrier to entry here.
What's fascinating here is the cost-benefit analysis happening at the management level. You don't just declare you are using hedge accounting.
Yeah.
The IFRS 9 compliance requirements are punishingly strict.
How strict are we talking?
I mean, managers have to formally document the risk management objective, the specific hedging instrument, the hedged item, and the precise nature of the risk being hedged at the very inception of the transaction.
So it's not a retroactive thing, and I imagine it goes way beyond just the initial paperwork.
Oh, absolutely.
Yeah.
They have to continuously prove the hedge is mathematically effective, the statistical burden is heavy.
So they have to test it constantly.
Yes. Companies have to conduct ongoing effectiveness testing. They have to prove that the changes in the fair value of the derivative highly offset the changes in the fair value of the hedged item.
And what happens if the correlation slips?
If it slips outside a very narrow mandated range, you lose the hedge accounting designation entirely. You're thrown right back into the fair value volatility.
Wow. So managers have to weigh the market benefit of a smoothed income statement against the tangible costs of building specialized accounting infrastructure, hiring experts, and enduring rigorous audit scrutiny.
Exactly. The huge commitment.
That dynamic sets up the core investigation of the thesis perfectly. We have a tool that offers clarity but demands massive resources. So the author analyzed 158 non-financial companies on the B3 exchange across a 5-year window from 2018 to 2022.
Which is a great sample period. It covers the baseline pre-COVID years, the absolute peak of the pandemic crisis, and then the immediate recovery.
And the B3 is an excellent laboratory for this, right? Emerging markets typically experience way higher currency and interest rate volatility than developed markets.
Oh, for sure. Making hedging strategies absolutely critical for operational survival in Brazil. And the data provides a very clear picture of how these companies performed.
Right, so let's get into the data. The first major conclusion drawn from the data focuses on baseline performance. Designating hedge accounting actually exerts a positive, statistically significant influence on a company's economic performance.
Measured through return on assets, or ROA, and their profitability margins.
Exactly. So the firms that absorbed the high compliance costs of hedge accounting actually generated better returns.
Yeah, and the mechanics behind that performance boost are deeply tied to corporate governance. When a firm commits to the transparency of hedge accounting, it totally changes the way capital markets interact with them.
This feels like a classic agency theory problem.
Oh, 100%.
You have the managers, the agents who possess all the internal knowledge about the company's risk profile, and then you have the investors, the principals, who only get to see what the agents publish.
Right. The agents might want to obscure risky behavior, while the principals just want a reliable long-term return. That creates a massive gulf of information asymmetry.
But by voluntarily adopting hedge accounting, managers are actively bridging that gap.
Exactly. The rigorous documentation required acts as a highly credible signal to the market. The managers are effectively saying, look, we are managing our exposure so responsibly that we are willing to submit to the highest level of audit scrutiny just to prove it.
Which flushes out the noise of those wild derivative mark-to-market swings. It allows investors to actually evaluate the true operational success of the firm.
Yes. Rather than viewing hedge accounting as just an eraser that cleans up the books, it's more like a pilot relying on an instrument landing system in heavy fog.
I like that. The fog, which is the macroeconomic volatility, is still out there.
But the ILS provides precise, undeniable data that allows the pilot to communicate with air traffic control and land safely. The passengers or the investors trust the process because the instruments are reliable.
And when information asymmetry drops like that, investors naturally demand a lower risk premium. the cost of capital decreases, and we see that reflected directly in improved metrics like ROA.
The cost of capital reduction is the real financial reward for all that transparency.
Okay, here's where it gets really interesting.
Let's hear it.
The thesis asks what happens to this carefully constructed ecosystem of trust and transparency when a completely unpredictable exogenous shock hits the market.
Because the pandemic wasn't just typical market volatility, it was a complete cessation of normal economic activity.
The systemic shock of early 2020. I mean, supply chains froze, demand evaporated instantly, and historical data became practically useless.
And the thesis data confirms the obvious, right? COVID-19 severely negatively impacted profitability across the board for these 158 companies.
But the critical question is whether our high-fidelity instrument system hedge accounting provided any real protection during that.
And the findings are definitive. The expected joint benefit of utilizing hedge accounting during the pandemic did not statistically protect the company's performance.
Wow. So the magnitude of the crisis just simply overwhelmed the stabilizing effects of the accounting choice.
It did. The operational bleeding was too profound. If your factories are legally mandated to shut down and your inventory is just rotting on a dock, smoothing out the fair value of a currency swap on your income statement doesn't change the fact that your cash flow has stopped entirely.
Right. The underlying asset itself was impaired. The hedge protects the price of the transaction, but it cannot protect the actual existence of the transaction itself.
Exactly, which naturally leads to another major pillar of the study, which is value relevance.
Right. We're looking at whether investors actually use the provided accounting information to price a company's stock.
Yeah.
And the thesis uses the Olson model to measure this. Now, my understanding of the Olson model is that it's basically a mathematical framework linking a company's market value directly to its book value and its expected future abnormal earnings. Is that right?
That's spot on. The Olson model essentially tests the explanatory power of the financial statements. If the accounting data is highly value relevant, changes in book equity and net income should correlate strongly with changes in the company's stock price.
Okay, that makes sense. And in a stable environment, hedge accounting naturally increases value relevance because it provides a cleaner, more predictive earnings number for the Olson regression to latch onto.
Correct. But the thesis found a major disruption here. During the COVID-19 crisis, the overall value relevance of accounting information actually decreased.
Really? So the link between the pristine hedge-accounted financial statements and the stock price weakened significantly.
Yeah, if we connect this to the bigger picture, it illustrates a fundamental shift in investor psychology during a systemic collapse. In a normal functioning market, investors use earnings to forecast future cash flows. But when a massive macro shock occurs, the basic premise of a going concern is temporarily thrown out the window.
Huh. The investors stop looking at the income statement because profitability is no longer the immediate priority. Survival is.
Exactly. The accounting data simply loses its predictive power. I mean, a strong Q1 earnings report, even one clarified beautifully by hedge accounting, offers zero insight into whether the company has enough actual liquidity to survive a 6-month global lockdown.
So market participants just shifted their focus away from accrual-based accounting metrics. They started looking at raw survival indicators, cash burn rates, debt covenants, central bank interventions.
The market effectively decided that the accounting information, no matter how rigorously prepared, was insufficient for the reality of the moment. The Olson model lost its grip because the variables investors actually cared about had changed entirely.
Wow. Which sets the stage for the final and I think arguably the most surprising finding of the thesis. It involves this concept of conditional conservatism, which is measured through the Basu model.
Yes. Conditional conservatism is one of the most fascinating psychological elements hardwired into traditional accounting.
The core philosophy is totally asymmetrical, right? Anticipate all losses, but anticipate no profits.
Exactly. In practice, this means accountants must recognize bad news immediately in the financial statements, taking write-downs or recording expected losses, while strictly delaying the recognition of good news or gains until they are absolutely realized and verified in cash.
And the Bossi model provides the mathematical gauge for this asymmetry. It basically runs a regression of accounting earnings against stock returns.
Because the stock market reacts to both good and bad news in real time, the Basu model measures how quickly those market reactions show up in the actual accounting earnings.
Right, and the model typically shows that earnings are much more sensitive to negative stock returns than to positive ones. The bad news hits the books fast.
Very fast. And this creates a severe theoretical clash with the IFRS 9 rules we discussed earlier.
Because hedge accounting, based on fair value measurement, is inherently symmetrical.
Right. If the derivative gains value, you record the gain. If it loses value, you record the loss. It's balanced.
So the symmetry of fair value directly opposes the asymmetry of conditional conservatism.
Exactly. And the baseline data in the thesis reflects exactly that conflict. Under normal conditions, utilizing hedge accounting actually decreases the level of conditional conservatism in a company's reporting. The mathematical symmetry of the hedge overpowers the cautious asymmetry of traditional accounting.
But the pandemic introduced a massive twist here.
It really did.
During the COVID-19 crisis, the data shows that hedge accounting suddenly exhibited a positive relationship with conditional conservatism.
That is the pivotal anomaly of the study.
Yeah. Wait, how can a perfectly structurally symmetrical accounting rule suddenly become asymmetrical just because there's a virus? The standard didn't rewrite itself overnight.
No, the rules didn't change at all. But the behavioral incentives of the managers executing them did. The BASU model captures the ultimate output of managerial discretion. When the systemic shock hit, managers were facing an environment of unprecedented ambiguity, knowing full well that capital providers were incredibly prone to panic.
So the information asymmetry we talked about earlier suddenly became a life or death issue for maintaining investor trust.
Exactly. To prevent a mass exodus of capital, managers had to signal extreme credibility. In a crisis, optimism is viewed as suspicious, but pessimism is viewed as honest.
Oh, that makes so much sense.
Right. So managers likely engaged in heavily conservative reporting strategies, often referred to in the industry as taking a big bath.
Taking a big bath, meaning
Okay.
they recognized every conceivable loss, impairment, and write down immediately to clear the decks and prove they were hiding absolutely nothing.
Yes. They flooded the zone with bad news to establish a baseline of trust. And that wave of managerial defensiveness was so overwhelming that it bled into every aspect of their reporting.
So the human element of panic and self-preservation effectively overrode the mathematical symmetry of the hedge accounting framework.
The crisis forced managers to subordinate the neutral objective of fair value matching to the immediate, desperate need to signal caution. The BASU regression picked up on this intense defensive asymmetry, basically demonstrating that human behavior under extreme duress will bend even the most rigid accounting frameworks.
That is just incredible. So what does this all mean for you listening? Whether you are analyzing a potential investment, preparing for a strategic corporate role, or just trying to understand the mechanics of the market, the key takeaway here is that financial statements are not objective laws of physics.
Not at all.
They are complex narratives constructed through choices. How a company chooses to manage and report its risks, like absorbing the heavy compliance burden of hedge. Accounting fundamentally alters the reality presented on paper.
It shifts the perception of risk, it changes the cost of capital, and it dictates how transparent the business appears to the outside world. And this raises an important question that extends far beyond just the B3 exchange. The thesis proves with empirical data that during the ultimate stress test of the pandemic, the standard relationship between rigorous accounting rules and investor trust just fractured.
Right. The models tracking value relevance and conservatism behaved in entirely unexpected ways.
Which forces us to ask, are our current highly complex global reporting standards like IFRS 9 actually robust enough to provide clarity during modern compounding global shocks? Or are they fundamentally fragile frameworks that only really function as intended when the macroeconomic waters are calm?
That is a phenomenal question. It definitely makes you look at every safe earnings report with a much sharper, more critical eye. A massive thank you to the graduate program in accounting at the Federal University of Pernambuco for facilitating this vital research. And of course, to Elenilda Santos Bezerra and Profa, Draw Umbelina Cravo to Shara La Gioia for the incredible depth of their work.
Yes, truly groundbreaking stuff.
Remember, the numbers on a spreadsheet are just the beginning of the story, not the end. Keep questioning the mechanics, keep looking beneath the surface, and we will catch you on the next deep dive.